At what point would Ray close me down if I was pitching to the investment policy committee at Bridgewater? Ladies and gentlemen, it is with trepidation, joy, excitement that I welcome you into the bowels, the hot, sweaty bowels of St. Bart's and another Asset Capitalist podcast. Hold that thought. In 3 weeks' time, less than, the summer camp in St. Bart's will be commencing. We still have I could still sneak one or two of you in. You don't have to be finance. You just got to be curious. This one's going to be the best because, I've got Jeff Snyder. I've got the milkshake man himself. I've got Brent coming. I've got George Gammon. I'm saying, George, you cannot bring your whiteboard, but maybe we'll sneak it in. I'm sure we will sneak it in. Anyway, kicks off on the 21st of August. Be there or be square. Anyway, the trepidation, the excitement relates more to the fact I've got Bob Elliot. And he's not just another Bob. This is a veteran of the house of Ray Dalio. Sat on the most important investment policy decision-making levels of that behemoth. What he doesn't know about FX, what he doesn't know about the world of macro, I'm just making up. Anyway, drum roll over, Bob. How the hell are you?
Good. I think that's the best introduction that I've had on a podcast. I'm going to take that and I'll use that one for the future.
It's all about the asset, baby. Now people are saying, "Oh, watch out! Bob's a smart guy," and I don't think you guys are gonna agree. I mean, you look like a very friendly, amiable person. You've been around. I've been around. I'm sure we're going to get on. I know we're going to get on like a house on fire. I imagine where we're going to try and take the folks, and again, I must just add, principally this is a platform for the Patreons of the Asset Capitalist. We're putting out up to about 30 minutes as a teaser. We'd love you to join. We'd love you to become Patreon members. Various packages, one of which you can you get to dial in and you get to speak to me in St. Bart's. You can tell me about lady troubles or money troubles. I entertain them all. Anyway, so the 30 minutes are taking away. And I think where we're going to, the great leap that both of us are seeking is a leaping from today into this dismal or glorious place tomorrow. But before we do that, again, remember people, if you're worrying, you're in the future. If you're wishing, you're in the past. This show is all about bliss. Bob is full of bliss. And the bliss belongs to today. So today, Bob, I understand you're having a pretty damn good day, a pretty damn good year. You give me your prejudices, lay down your narrative. I'm listening.
All right. I think we are in a lot of ways experiencing a typical late cycle inflationary dynamic. The path that we got here was a little bit unusual, although not that unusual, in the sense of we had big fiscal stimulus, created a rebound in the economy. We had a traditional inflationary shock that exacerbated the inflationary pressures. But if you look at, if you're sort of a boring macroeconomist and you look at how cycles typically work and you basically say, look, unemployment's at secular lows and cyclical lows. Wage growth is rising and is growing pretty strong. People are spending. There's nominal growth. There's reasonable price pressures as a function of that. That in many ways. And then there's a central bank that's responding to that by tightening monetary policy in response to that in order to slow those inflation pressures, slow down the economy, and eventually, bring that inflationary backdrop back down to the target. Like at that level, it's like pretty boring. It's pretty normal, right? And I think in some ways we have gotten lost in the fact that there's all of these other things that are going on that have sort of forced us here. And we've lost the fact that, macroeconomic cycles like this, they take a long time to play out. It's very slow moving. Like the fact that, the Fed, it was only like 15 months ago when the Fed was printing money and interest rates were at zero and people thought that there was going to be a recession in the span of 6 months. Like it's not how it works. Like macro cycles take years to play out. We're, 15, 18 months into that dynamic. And, it's been a little slower than I think even I expected, but macro cycles are pretty slow. And so now we're basically at the point where, will there be enough tightening or will the Fed do enough tightening in order to topple the economy? Or of course it could happen from market dynamics, which is you could have, the long end rise enough to topple the economy and markets and create the slowdown on the backside. And so that's kind of where we are are we 3 months from that, 6 months from that, 9 months from that? That's kind of the question that we're at right now.
Okay. So have you spent much of your professional career formulating and implementing ideas based on reasonable meetings with reasonable economists?
I don't follow economists. I don't like economists. I guess I am an economist in some way, but not really, right? I'm a markets person. So I don't, the economists can say whatever the heck they want. They don't have a particularly good track record of trading financial markets. And so they're not really a key input into how I'm thinking about it. But what I would say is I have spent 20, 25 years studying macroeconomies and how they work and how they function and how cycles work and play out. And, my views and my understanding is really connected to that, having seen a certain number of cycles, but also having really studied, a lot of cycles and dynamics over the course of the last 150 years to understand and appreciate, what about what we're doing here is similar to those cycles, what's different, and how do you then translate that into a forward path of what's going to happen.
Okay. So I think that the people tuning in, I think, would be really intrigued to understand a little bit about daily routine, but more importantly, your takedown of those cycles and relating it to today, right? So the narrative that you've formed from this understanding of multiple cycles over the last 150 years, looking for the similarity and I guess the difference, and then the major data or price points that then come in and either legitimize or challenge, shock, like where you are. Could you maybe expand upon that?
Yeah, for sure. So, a lot of what I'm looking at, you can think about how the macroeconomic cycle works by, you got to look at, there's basically where you are cyclically, which, measure that a bunch of different ways, which is like, you look at the unemployment rate. That's where we are cyclically. Good enough. That's a sort of point in time vision of where we are. Then you want to connect it to understand what's happening with the leading cyclical sectors and how they're evolving, right? And right now, actually, we had a bit of a weakening in the back half of 2022, but actually some of those cyclical sectors are starting and have picked up. They've stabilized and picked up a bit, housing and manufacturing. And then you want to look at, so that gives you a sense of the momentum, which is we're late cycle. Growth has been about at potential or a bit better. Cyclical sectors are rising or at least not falling. And so all of that points to sort of your baseline expectation of kind of an at-ish or maybe a touch above potential economy, which is sort of the fundamental momentum of the economy. And then what you want to do is you want to compare that to what's going on when it comes to fiscal and monetary sstimulation, where there has been a relatively sizable fiscal impulse on the economy through a bit of a widening of the deficit, and sort of cutting against that, a monetary tightening. You sort of net those two things out, and what you'd say is like that's probably netting out to a drag on the economy relative to that. And so you put those things together and you sort of say, yeah, of course we printed 2.5 or so in the second quarter, but odds are that we're going to see a slower economic set of conditions over the course of the next 3 or 6 months. Not a disaster. We haven't tightened hard, right? Just enough of a slowing to keep us, at potential or a little bit below potential. But then you want to connect that to, but not nearly enough of a slowdown to resolve the inflation problem. And so what that means when you put that all together, you compare that to what's priced in, which is basically an expectation to a shift to relatively easy monetary policy in 24. That, given the set of conditions we're talking about, is unlikely to happen. And you compare that to what's being priced into the equity markets, which is, what's priced into the equity markets is 12% earnings growth in 24. And that also is unlikely to happen. Like, you can't have both of those things play out given the set of dynamics that I'm describing. Now, of course, there's other things to think about. This cycle, because we're sort of in an old time cycle, like a cycle akin to the 50s and 60s, you can kind of think about it in some ways more simply than that. There's other times when credit becomes a much more meaningful impact on the economy and the long-term debt cycle. That's not really where we're at right now in the U.S. or in other cycles.
Sorry, say that we're not. Where are we not? We're not.
We're not long-term debt cycle problems, which obviously were extremely relevant in the 2008 cycle, aren't really relevant anymore. Like, those are not the relevant things to be thinking about. You really want to be thinking about this dynamic, this current environment, macro environment, in the context of a more traditional cyclical environment, a wage-driven, income-driven, cyclical upswing that's getting us to late cycle inflationary pressures, which is much more what a 50s or 60s style macro cycle looked like than, a 2000 or a 2008 cycle.
How do we get to but how did downplay perhaps the significance of debt versus 15 years ago? Because it's only gone higher. Yeah, the gross debt to GDP, whilst it's supported by a similar level of assets, the ledger matches. But we're approximately 3.5 times debt to GDP, across all sectors. Why is that not relevant? Because that's much greater than it was in 2008, and really the focus, the potency, which is either being called into question or otherwise, is monetary policy, which is raising the carry on a level of debt to GDP which is without precedence.
Yeah, well, I think it's important to connect there's sort of two ways to think about this dynamic, which is you want to think about it in terms of the levels of debt, but you really want to think about it in terms of the flow of debt, because it's the changes in the flow of credit, the changes in the borrowing that have the meaningful impacts on current economic conditions. And so the thing that's different about this cycle, like if you go back to 2008, credit, mortgage borrowing was booming. There was a lot of leveraging up of companies leveraging up, right? That whole dynamic, once you started to see the credit risks emerged, created a very fast and acute credit deleveraging, right? Credit came down fast, which created the economic pain that many people felt. In this cycle, very different. Credit in the private sector has actually been at secular lows it's been extremely subdued, right? Because households aren't borrowing a ton of money after the old financial crisis. Corporations haven't really needed to borrow a ton of money. And so the impact of the interest rates on incremental borrowing this cycle is much lower because borrowing was already low. And instead, what's financing the expansion is income, whether it's corporate earnings and cash flow and profitability, or it's households just, getting wage income. And it's why I think a lot of people will sit there and they'll show charts of the slews and things like that. And they'll say, look, it's a total disaster. And the answer is it doesn't matter that much, right? Like, it matters a lot more that people are getting 5 or 6 or 7% wage increases than it does that on the margin, they're not borrowing for their, they're not really going out there and buying a bunch of homes because they weren't really buying a bunch of homes before on leverage. And so the fact that they're not really doing much of it today doesn't really matter to the economy. And so that's the real difference. I think, of course, critical to connect the government side of things, right? Which is that a lot of that private sector debt has been replaced by government debt. And so that changes the dynamic because private sector debt has credit problems and government debt has currency problems, basically. Like that's how to think about that connection.
Has public debt replaced private debt? My impression is both public and private debt have actually just both have risen. All debt in all sectors has risen. I accept your credit worthiness and in that aspect, but absolute debt levels of debt associated with the principal economic agents in the U.S. economy have risen, no?
Well, what I'd say is that the debt burdens have not risen, particularly for households and for businesses. And a big reason why that is because there was a pretty significant restructuring of the debts. And this is where, like, just looking at debt levels is not necessarily the best indication, whereas understanding the structure of the burden is the thing that you actually want to be thinking about. And the fact that, businesses used to borrow floating on the front end of the curve, with very short durations, like 3 years or 5 years, and they used the big liquidity in the system during QE to term out that debt. In the same way, there was a time before 2008 when households borrowed 50% on the short end, in terms of their mortgages. They were short end floating mortgages in one form or another that, were being reset relatively quickly. Well, they too termed out their debt, right? And so if you're a 2% mortgage holder, like your debt burden is a lot lower today than it was back in 2006 or 2008. And so the burden has come down a lot, actually. Even though the levels might be different. And it's why, a debt due 40 years from now is not the same as a debt due 5 years from now. They're radically different.
No,
right? Because the time that you can earn income is radically
different. No, I get that. I mean, it's almost, actually just thinking about it off the cuff, the pandemic was almost like the ultimate cleanup of the European sovereign crisis, where they extended and pretended, if you will, where essentially the Greek debt was like due between 7 and 10 years. And they're like, yeah, let's make it 30 years. Yeah. And I want to say that this is you'll know it better, I believe. But I want to say this is really quite a unique period of Fed tightening in the sense that in that 2021 period, corporate America and the U.S. household sector refinanced at 30-year at incredibly low rates. And so the Fed has acted very, very quickly and with a magnitude which is beyond the pale versus historic comparison. And then sat there going, it's not slowing down, it's not slowing down. But that's to your point, that the interest, I think mortgage interest service is at least half of what it was in 2008. But that's where we are today. I mean, that's come through, right? That's why equity markets and other risk assets are where they are. But the point I want to put back to you is that essentially there was a risk that had been transferred within the economy, but a risk transferred is not a risk eliminated. Yeah. And we saw the demise of 3 banks, which is kind of classic in the early tightening phase. In August 2007, we lost a major British financial institution. In March 2023, we lost very carelessly 3 American institutions and plus a behemoth from the Swiss Alps. And typically, it goes away a little bit. The volume gets surrendered somewhat. When I look at the bliss of now, is there a concern that actually this monetary tightening, which has been invisible in its presence, does it come all of a sudden, if you will? Now I can see that outside America. I can see that in Canada, Australia, United Kingdom with the nature of their mortgage market, where Again, they fix like the US household sector, but they only got to fix for 2 years. And that 2-year wrapper is unfolding, and they're going to be presented with the now, which is considerably greater. The household sector doesn't have that, but there are colossal financial exposures. What does a finance group do? It borrows short term and it lends long. And you had 10 years of incredibly low, like the ZERP era. Yeah. And so we know that there are assets within the financial sector of trillions of dollars that are at the wrong level versus short-term financing. So I would anticipate we see a coughing up, a revelation of that transferred risk having to come in, and it becomes more resilient with danger the longer the Fed stays. I think there's a lot. What I want to say is there's a lot of financial institutions saying, I can just about keep the pretense, but I really need you guys to start lowering rates. Otherwise, I'm going to have to tell everyone I'm insolvent. But, that's my colorful language.
No, I think that's a good point, which is the flip side of the fact that the households are only paying 2%, as an example, on their mortgage rate, is that the value of the mortgages is, at 80 instead of at 100 in which they were bought. And so the question is, there's mortgages in the specific, and then there's all sorts of other crazy lending that occurred during the QE time when people were trying to figure out how to move capital, take that liquidity and move it into higher yielding assets. I think it unfortunately is something that requires a bit of a sharp pencil, because I think in some ways there was restructuring in terms of liquidity and extension and lowering of interest rates from the borrower's perspective. There was also pretty important restructuring of the banking system and levered financial intermediaries that happened post-financial crisis, which really changed the riskiness, both the actual riskiness, but also the regulatorily constructed riskiness of those institutions. And so the fact that we've got banks, in 2008 that were running at between 30 and 50 times leverage versus a set of banks today that from a regulatory perspective are running at 10 times leverage or less, 8 times leverage, is a pretty big difference in terms of how much pain they can withstand. And then I think on top of it, you've got the fact that they've basically been given total regulatory relief to buy duration in one form or another. And then it only comes up because there's a run. It doesn't come up because there's a regulatory pressure. It comes up because there's a run on the bank. And only then is that problem exposed. And so I think the real question is, are there runs on the banks? Like, is that what's going to happen? What would inspire another set of runs on the banks to crystallize those, bonds trading at 80 instead of 100? Yeah,
no, indeed. Do you have any, is there any valid, not easy, but can you actually get the data on? So you mentioned regulatory encouragement to load up on essentially high duration, long duration treasuries. And that's comes under the moniker of hold to maturity. And you get, the blessing that you don't have to reveal, you don't have to mark to market gains or losses. And in the last 2 years, it's only losses. And of course, that was the insolvency event for, the 3 banks in March. Bank of America, I think they didn't reveal in their last quarter results, but in the annual results, they reveal the unmarked loss on their HTM. Do you have like a bank system wide figure for the present unrealized HTM loss?
Yeah, I mean, it's on the order of hundreds of billions of dollars. And of course, it depends on which day we're talking about, right? Today,
one bank, Bank of America, substantial bank, accounts for 135 billion.
That's right. Although Bank of America, and now we get into the nuances of the regulatory infrastructure, but like Bank of America has to book those unrealized losses against their capital and hold capital to take that into consideration. And so it actually, those issues at the GSIBs is not really a big problem. The real problem is in the smaller banks that report regulatory capital where the regulators are holding them to capital ratios that are not inclusive of their unrealized losses, and so they're effectively more lowly capitalized in the event of a bank run than it would appear if you just like read their tier 1 ratios, right? And you'd say they look like they're 12, but the reality, the economic reality, is meaningfully less than that. But that only gets, but like the regulators have a choice, and I think that's part of the thing that you actually see. The financial crisis actually kind of skewed our understanding, because what happened was there was a bunch of losses that came super fast that were credit losses that basically couldn't get swept under the rug. Losses like what we're seeing right now.
They weren't credit losses. They were losses. They weren't credit losses. They were mark-to-market losses on supposedly the riskless component of their asset base, their treasuries.
Yeah, I'm saying in 2008 they were credit
2008. Forgive me. Forgive me.
Yeah, in 2008 they were credit losses, and the problem is, to be honest with you, the regulatory regime basically was like, if credit losses happen, you have to book them and go bankrupt, right? And then eventually what happened was the Fed and the Treasury came in, and the European regulators came in and said, "Oh, that is silly. We should not do that. We should figure out a way to let them, to recapitalize them and put them out into put it out into the future, so that we don't have this cascading thing." In this case, like, the issue is there's actually a lot of regulatory leeway to not say that the banks are insolvent, right? The banks could, because the regulator can basically say, okay, you've got an unrealized loss, but we're still writing 12% in on your tier 1. And so you're good to us, right? And it's only the pressure, like with SVB and then First Republic and Signature, was because there was a run. And the reality is, if there's a run, the run occurred because it was unclear how the regulators would handle the unrealized losses for these banks. And now what we've seen is that the regulators basically sit there and they say, it's fine. Fed will provide the liquidity. The regulators will provide the relief. And so it's interesting, like, we've seen this bond sell-off in the last couple of days. And if you go look at the KRE index, it actually, it's not moving much. I mean, relative to what you would think if this was a huge problem, you see the KRE index doesn't really move. And I think that's because there's this recognition that if this is the nature of losses, very long duration securities that we can kind of forget about, look past, carefully turn a blind eye to, that, the banks can keep operating a bit on the myth that there's no problem with that mark-to-market outcome.
Yeah. Just to throw into the mix, the confidence in the regulators and what will. Credit Suisse did fail as a systemically important bank that had the additional scrutiny of the global regulators. And it did fail with impeccable regulatory risk ratios. And just about most banks have failed with impeccable regulatory risk ratios. And so if there were to be unforeseen bad circumstances in the banking sector, it would seem that it probably will come as a surprise and a shock to the regulator. But we have reached we've reached that point in the transmission, Bob. We have reached that point where I have to bid farewell to some people, that the little teaser is coming to an end. And I want to say, you're going to miss the best bit, because so far I've just been, it's been like both of us, we've been like, it's like a huge bowl of the economy, where we are, where we're going. It's been like this huge pile of spaghetti, and it's all stuck, and we're pulling strands. And frankly, I'm getting bored. And so I think the next...
Oh, man, what's happening in the next after this break?
Exactly. What's happening in the next section? I'm going to light a fuse under Bob's ass here and start making this more interesting. So anyway, Patreon people, summer camp, until next week for some of you. And to the others, I'll see you on the other side.